when you do an exchange, you cannot exchange into a partnership. You cannot exchange into stocks, bonds, or notes. You cannot exchange into a partnership. So the question was asked, could I exchange into a syndication? And the answer is no, you cannot, because you're not receiving a deed to real property.
Welcome, everyone. How would you like to learn how to save 30 to 40% in taxes after you sell your real estate? How can you do this, you may ask? Well, there's something called a 1031 exchange that can help you. To help us navigate this process, I'd like to welcome Bill Angove. Bill is the California State Manager and Senior Vice President of Asset Preservation and has been with API for over 23 years. He's been invited to numerous national conventions as a guest speaker on 1031 exchanges and also teaches on the topic. I think it's fair to say, Bill, that you are a 1031 celebrity. Is that true?
I haven't heard that one before, but okay.
Okay. Well, we're going to do something different today. I typically have a list of questions to ask our guests, but Bill has put together an entertaining and comprehensive presentation that really goes through all my questions. So I'm going to let Bill present this, and I will ask you questions as we go.
Welcome to everyone. My name is Bill Angove, and as pointed out, with Asset Preservation, we are a qualified intermediary for 1031 exchanges. Our company has been around for over 30 years now. We've done over 250,000 exchanges, believe it or not. I've been with the company for 25 years, and what we're going to do today is answer hopefully some basic questions on 1031 exchanges for you. What I'm going to talk about is, potentially what are the benefits? Obviously tax deferral is one of those benefits. I'm going to talk about the infamous what is like, kind, in an exchange. I'll walk you through some numbers, and then also I'll show you the exchange or delayed exchange process as we know it. So let me just go through a couple of slides here. So you have a choice. You own an investment property anywhere in the United States. You can hold on to that property. You can sell it in 2023 or beyond, or you can do an exchange. And the last bullet point says you can defer all your capital gains through a 1031 exchange. And actually, 1031 exchanges have been on the books for over 100 years. This is not some recent loophole that somebody put into the IRS code. It's actually been around for quite some time. The format that we're doing it today has actually been around since 1991 in the identification rules and things that I'll walk you through today. I just covered that slide, so we'll move forward. I'm going to start with an example. And this is a common example, especially here on the West Coast where I'm located. We have a family that bought a property for $400,000 years ago, and now it's worth $1 million. And people say, well, okay, my gain's $600,000. Well, no, if you've taken depreciation on the property, you see the fourth bullet point, the net adjusted basis for tax purposes is $100,000. So their actual capital gain is $900,000. And the tax rates are fairly huge. As he pointed out, you're looking at 30 to 40% of your equity going away in a tax. So if you look at the chart that we have up there, the depreciation you've taken on the property gets taxed first at 25%. This is federal taxes. The balance of the gain of $600,000 is then taxed 20%. Some of you may be asking yourself, well, I thought long-term capital gains tax rate is 15%. It is until you have a certain amount of gain over, let's call it $550,000. That kicks up to 20%. And many people aren't aware of the net investment tax. The net investment tax is a result of Obamacare. This is how they paid for Obamacare. And so that whole $900,000 gets taxed at another 3.8%. And here in California, where I'm located, the top tax bracket is 13.3%. So California is going to take another $119,000 in the form of tax. So reviewing, I bought for $400,000. I'm selling for $1 million. I'm going to pay $348,000 in tax.
Let me ask you, because this is a super powerful slide here, and let me ask you a few questions and make a few comments. As far as depreciation recapture, people sometimes don't understand this concept. People understand depreciation. There's a huge advantage in investing in real estate. You can write, there's a significant amount of passive losses that you can capture at the beginning of your investment cycle, but then you have to pay that back. And some people don't realize that. That comes on the time of sale. And the rate on that is 25%, as Bill mentioned. Capital gains tax, again, that's the second line, that's less than depreciation recapture. So the way a lot of these CPAs try to put these together is to try to maximize your capital gains and minimize your depreciation as much as possible, based on, kind of all the magic that they do when they're putting together your returns. Um, as far as the net investment tax, I wasn't aware of that. Is that something that's throughout the US, or is that only in certain
No,
states?
that is federal. Yeah.
That's federal. Okay.
Mhm.
And then obviously you have your state tax, and some people forget about that. You have to take that into account. And in California, that's massive. I imagine that's probably the highest state tax in the
It's one
US.
of the highest. Yes.
Okay. Excellent.
So after we pay the taxes, the bottom line there, you see that they've got $651,000. And if someone sells and pays the tax and they want to reinvest what's left over, the example I show here under replacement property purchases, they've used that as a 25% down payment or a 75% loan to value. They can leverage that to $2.6 million worth of property. But really, and here's the biggest power of an exchange, it allows you to sell, defer. You don't eliminate the taxes. It's not tax free, it's tax deferral. I like to say swap till you drop. Or what some people will do is they'll exchange, and then refinance the replacement property down the road to pull some cash out to use it for more other purposes like buying more property. So the real power of an exchange is you're deferring that tax. You take that $1 million at the same loan to value and look how much more property you can buy. So that's number one, first and foremost, what the benefit is of the exchange. I'm not going to go word for word here, but this is basically what the IRS code says today. It says no gain or loss should be recognized on the exchange of real property. Okay, what that means is anytime that you're selling a property that's not your primary residence, you can sell, not recognize that gain, defer the taxes, and buy new investment property anywhere in the United States. Here in California, we have quite a few people that are exchanging out of California to Idaho, Tennessee, the Carolinas, Texas, Florida. Those are a lot of the destination locations that they're moving their property, their rental properties to, but they're also planning on moving there down the road. And the term like kind, we'll talk about like kind in just a minute, but like for like is very misunderstood. Many people think like kind is rental property for rental property. That's not true. It's any type of property held for an investment. And one of the things we discussed before starting the video is when you do an exchange, you cannot exchange into a partnership. You cannot exchange into stocks, bonds, or notes. You cannot exchange into a partnership. So the question was asked, could I exchange into a syndication? And the answer is no, you cannot, because you're not receiving a deed to real property. Did you want to add anything onto that?
Yes. If your syndication does sell and you've invested money into that, you can be an LP investor and 1031 that money into another property, correct?
Actually, if you look at the fourth bullet point down, an interest in a partnership is not exchangeable. And we see that often where people own properties in a partnership or some other circumstance, and they want to sell and go their separate ways. Well, the way they look at it is that the taxpayer, the entity that owns the property, would be the syndication. That's the taxpayer in the IRS's eyes. So you cannot exchange out of a partnership. You would need to drop it out of a partnership down to the individual owner's names. So they're a seller of the real property. That's the only way it works.
So you can make it work, but it just requires some legwork to make it happen.
That's usually when you tell them you want to get a tax attorney involved and look at the timing of when you would drop it out of the partnership down to the tenants in common. The smart money these days is do it the year before the actual sale of the asset. So you maybe owned it in a partnership for 5 years. In 2023, you drop it out of the partnership into individual owners and then turn around, list it and sell it in 2024 is what the articles typically say on that area.
Okay.
Yeah. So this slide kind of pretty much demonstrates if you go in the property in a corporation, LLC, things like that, husband and wife individually, they can go their separate ways. If they're getting a divorce, if you and I owned a property together, we could each go our separate ways if we own the property as tenants in common. Often people own properties in trusts or LLCs. And so we just have to figure out what kind of LLC that is and who are the members of the trust. So sometimes we see where you've got the mom and dad have passed away, but the property's still in mom and dad's trust. And the trustees think they can do their own exchange. Well, they're not on title. It's mom and dad's trust. And so beyond that, I just tell people to talk to their tax person. So like kind, everything that you see coming up on the screen right now is considered like kind anywhere in the United States. You see office, apartments, retail, maybe a vacation home that's held for investment, at least for some time. We cannot do an exchange on a second home. That means strictly used for personal use, never rented out. Typically, your tax price is not going to say that works for like kind in exchange. but you see the various property types. So it's very broad. And that's one of the advantages of 1031 is you can diversify into different property types. You may want to be consolidating. You may own 5 or 10 rental houses and you're tired of the T's, tenants, toilets, termites, trash, and taxes. And so maybe you want to consolidate into a long-term triple net Walgreens or CVS somewhere in the United States. So those are some of the advantages. And also people take advantage of estate planning. Maybe their kids have moved to different parts of the country. So they want to buy properties where their kids are located. So when they do pass, those kids would inherit those properties where they're located. So those are some of the major advantages also.
So Bill, just to clarify that,
Yeah.
if you have a rental property, for example, a home, and you want to do a 1031 exchange into land, you can do that.
You can do that. The thing that you want to talk to your tax advisor about is you're going from a property that's been depreciated. It's a certain type of property, 1240, 1245 type property is what they refer to it as, to a non-depreciable property. So the land, so long as it's held for investment, is fine, but you may pay some taxes on that depreciation because you're not acquiring property that's also going to be depreciated.
And then from that land, you could reinvest into, I saw you had windmills and solar farms. You could do that as well.
So long as it's considered real property. Yeah.
Okay.
The cell tower sites is one of the things that we're seeing right now a lot of. If it's a leasehold interest, if it's oil and gas, something like that, it's got to be a perpetual lease, if you will. It's going to go on forever. These cell tower sites, if it's a lease deal, the lease has to be 30 years or more at the time of the exchange. So that is considered like kind, so long as there's a lease or lease options in place at the time that extend beyond 30 years. So those do work too.
Okay. And then you can also, something that our listeners would be interested to hear as well is you can also invest your money into a syndication as well. And that's happened often. So that is true, correct, Bill? I've seen that happen.
Can you exchange into a syndication?
Correct. So you sell a particular asset that you have and you exchange that into a syndication as a 1031 partner and you create a TIC structure.
Good. So long as you receive a deed to real property, yes, that does work. So if there's a partnership or a syndication that owns the property already, as I mentioned earlier, you cannot exchange into that entity. You would exchange into a tenant in common with that entity. That works.
All right.
Okay.
Great. Exactly.
Yeah. So moving forward, let's talk about the numbers. If you're new to 1031 exchanges, you may have heard or maybe remember the term buy of equal or greater value. And I'll kind of dig into this a little deeper as we go along. But you see in the example, the person selling for $900,000, they're going to buy a new replacement property for $1.2 million. So they're buying of equal or greater value. Now, clarification, these are not the IRS regulations. These rules are, if you do not want to pay any taxes, you want to do the 2 things listed at the top. Number 1, reinvest all of your exchange proceeds. Number 2, acquire property with the same or greater debt. So we start with the sales price of $900,000. My outstanding loan balance is $300,000, and my closing costs, that's my escrow title fees, or depending on where you're locating, maybe closing attorney and commission to the realtor is $60,000. So my proceeds out of the sale are $540,000. So I use all those as a down payment on my replacement property. There's no cash left over. So I have what we call zero boot. I'm not going to pay any taxes on any cash left over. Same thing on the debt. I replace the debt with a new $660,000 loan. So this transaction is 100% tax deferred. Can I buy a lesser property? The answer is yes, you can. But if you're going to have cash come out, you see the $100,000, that's considered cash boot. You're going to pay taxes on that. Also, remember that if you take on a loan that's lesser than your old loan, that $40,000 that you see on the screen is also considered taxable boot. So again, it's okay to buy a lesser property, but keep that in mind. Always want to run your numbers with your tax person if you're going to buy a lesser property.
Okay. So that's something new to me. I thought you had to buy a property at the cost basis or a greater cost basis, but you can actually buy a smaller property. You just have to pay taxes on the remaining, which you call the boot.
Yeah. And a lot of people are under that same impression that you only have to reinvest the profit over and above your basis. Unfortunately, that's not what we call the exchange equation. I like to say that you're in line behind the IRS. They get paid first before you get paid. So you can't just pull out your down payment, cannot just pull out your basis because it would be taxable boot. So we work off not the capital gain numbers, but actually at the sales price minus your closing cost commission. So really in this circumstance, this person, what the number they really want to work off of is $840, which is the $900,000 sales price minus my closing costs. That's what you want to buy for. And same thing in the commercial world. I said trade or business are held for investment. Well, if you're a contractor, a lawyer, or a doctor, or a dentist, you could do this for your own building. Maybe you have an old dilapidated building. You want to move into a different neighborhood. You want to buy a new building that's already constructed. So in this example, you look at maybe buying a new building. The relinquished property is free and clear. They put some debt on the new property. They have $720,000 left over that they would pay taxes on. So another option, and it's very similar to this syndication, is it's called a Delaware statutory trust. You have very large companies out there that go out and buy apartment complexes, office buildings. They buy the Amazon distribution centers. They buy the Dunkin' Donut office center, and they turn around and sell people a tenant in common, if you will, share. It's called a Delaware statutory trust structure. And you can buy into that. You have to be what's called an accredited investor, and you need to go through a financial advisor in order to cooperate with one of those. So I have more information. If people want to reach out to me, they can look at that. But that's been very popular with the boomers lately, selling multiple rental houses and buying into something that they don't have to manage anymore.
Are you investing in this trust? Is that what you're doing?
You're actually receiving a deed to a portion of that, in this case, office building. Yes.
Okay.
So you could have 100 different co-owners. You don't have anything to do with the say of when the building's sold or whether it should be repainted or not.
Right.
You're just a passive investor in this property. And most of them are outside of California, Denver and Jacksonville, secondary markets where the cap rates are a little bit higher than, say, San Francisco, LA, or Sacramento.
And then where do you find these properties? How would you find out?
So what the financial advisors that are specializing in these do, they work with a company, a big one out there is called Inland. They're out of Chicago. There's one here on the West Coast called Pasco. So they're what are called the sponsors of the property. And they market to these financial advisors. And financial advisors have clients that sell investment properties and want to go into these properties. It's not a liquid investment like a stock or a REIT. You're in there for a 5 to 7 year hold, typically. While they're going to add value to the property. So maybe they buy it for $100 million. And once the property gets to $120 or $110 million, 4 or 5 years down the road, they're going to say, okay, it's time to sell. What do you investors want to do? Do you want to do another exchange or cash out and pay the taxes? But it is considered a Reg D offering for the securities world. So you have to go through a financial advisor in order to purchase one of those. And they have if you will, a laundry list of properties that are available at the time they show the client.
So this is a way for an investor to avoid that boot, as you mentioned earlier, and put their money into a trust so that they don't have to pay taxes on that remaining.
Or maybe one of their, and I'll go through this next, maybe they identify 2 properties and they put the DST property as a third, a fail safe if one of the first 2 followed through in their identification period.
Okay.
So what you're looking at here is the basic structure of what we refer to as a delayed or forward exchange. If you've been around for a while, you'll hear some people refer to it as a starter exchange. That refers to the court case that really created the structure that we're working off of. The court case was in the late 70s, and that's when they came up with the 45 and 180 days in 1984. And then now with the identification rules, et cetera, those regs came out in 1991. But all you're really doing here is you're selling a piece of investment property, just like selling your primary residence. At the close of escrow, the deed goes to the buyer via your title company or escrow company, depending on what coast you're working on, or the closing attorney. What's different in a 1031 exchange is you, the taxpayer, cannot have constructive or actual receipt of your proceeds. So if you close and put that money in your bank account, that's a taxable event in the IRS's eyes. So that's what our role is we hold your proceeds between your sale and your purchase when you do an exchange. Now, what's interesting about our industry is we're unregulated on a federal level. There is no license required to do what we do. So scrutiny is important when you're talking to different qualified intermediaries out there. How long have they been doing this? What kind of expertise do they have? Where's my money go? Who controls my money? Is there some kind of parent company that backs the performance? Our company is owned by Stewart Title out of Houston, Texas. They're one of the largest title companies in the United States, and they back our performance 100%. We also carry bonding and insurance, which have never been challenged. So if people have questions on that, they can reach out to me directly. And so that's how the structure is. So there might be individuals out there acting as QIs, and the question comes up, can my attorney do it for me? Can my CPA do it for me? Unfortunately, they are considered a disqualified party because they're providing advice, financial or legal advice within a 2-year period of your transaction there. But it's very important that you look at where my funds are held. With our company, we're holding between $3 and $5 billion of people's money nationwide. So we go out to not just one bank, but several banks. We have an investment policy. Two of the banks that I can mention are we use Citibank and Capital One. We're not using Silicon Valley Bank or Signature Banks, just for latest times for people that want to be aware of that. So kind of over the events is you would put your property on the market, find a buyer, open escrow with a title company, and you want to engage us about a week to 2 weeks before close of escrow. What we're generally needing is to get your information, how you're on title. We reach out to the title company and ask them to send us a copy of the preliminary title report or title commitment. And then we have them send us a copy of the purchase contract. From there, we'll prepare our documents and send them to you. We do work with DocuSign for those familiar with DocuSign. A very easy way of signing documents this way. It's basically a stamp of your signature on a digital document. When you close, then your proceeds that you want to include in the exchange are sent to us. From that closing date, the total timeline you have to close on your replacement property is 180 days from the close of your old property. Currently, there's no extensions available. Now, I'm going to clarify that. If you're here in the West Coast of California, because of the storms in January and again in March, the IRS has issued extensions, and you'd want to talk to your tax person about that. We had the hurricane in Florida this year. The IRS also issued extensions on that. There was an event in Georgia. They also issued extensions. So generally speaking, there's no extensions available, but because of natural disasters, the IRS has issued extensions. Okay. Inside of that timeline, the blue period, that's the identification period. The regulations give you 45 days to identify in writing what it is you're going to potentially buy in the exchange. So what happens is we're going to send you the identification letter when you close on your old property. You'll fill that out with the addresses of the properties you're considering buying. You'll sign that document and send it to us before midnight of the 45th day of the exchange. Questions I get, do I have to have my replacement property in escrow in order to identify it? No. You can have it under contract, but if you write an offer on your replacement property before you close your old property, you would probably make your offer contingent upon the old closing first. Can I change my list? So one of the options is you can identify 3 properties, and I'll cover that in just a minute. So let's say on day 20, you identify 3 properties and you get out to day 40 and you can't or don't want to buy property A, B, or C. Great. You can revoke the old list and submit a new list. However, if once you're past day 45, that list is not changeable for any reason whatsoever. This is why we educate our clients, and this is why we've been doing this so long. If you get out to day 60 and you can't or don't want to buy property A, B, or C, you're going to have to wait. Unfortunately, the IRS regulations stipulate that you have to wait until day 180 expires to get those proceeds back from the qualified intermediary. This is a national rule. This is not our rule. It's not the QI's rule. It's the IRS's rules.
Bill, how many properties can you put on that list? Is there a limit?
Great segue. I appreciate that question. So I already covered the previous slide, so we'll go right to this. So they basically give you 3 options. The first option is the 3 property rule. It says you can identify up to 3 properties at any value. And you can buy 1, 2, or all 3 of those properties if you so choose. However, if you want to identify more than 3 properties, the 200% rule would be the second option. And the 200% rule basically states that if you list 4 or more properties, then the value of all of them combined cannot be more than twice the value of the property you're selling. So as an example, if I'm selling the property for $500,000 and I identify 4, 5, 6, or 10 different properties, this rule says all of them together cannot exceed $1 million, using my example. The last rule of the option, the 95% rule, says if you do identify more than 3 properties and their values do exceed twice the value of the property you're selling, then you must acquire basically your entire list of properties. The 200% rule and the 95% rule are generally on larger deals. If I'm selling a property for $10 million, easily I can identify more than 3 properties and stay under $20 million using my 200% rule. We see the 95% rule used not too often, but it has been used. Just all depends. Now, what if I want to sell 3? I want to consolidate. I'm tired of those tenants, toilets, termites, trash, and taxes. And I want to sell 3 and go buy 1 larger property. That's great. But the important thing to remember is you want to try to get all 3 of your sales closed within that identification period. Because you need to either close or you got to look at the value. So let's say each one of those is $200,000. So you're looking to buy something that's $600,000 or more. Well, let's say you get property one and property two sold, but you can't get property three sold in time, and you need to close on your replacement property. You're going to be doing an exchange with $400,000. So ideally, one buyer for all three, or put in clauses or extensions or whatever you want to do on the other properties to make sure you can try to get them. They don't have to close on the same day, but typically within that identification period. What if I want to sell one and buy three? That's fine. But again, you've got to get all three of those purchases closed within that 180-day window. So here's what we're going to do. When you engage us a week to 2 weeks before closing, as I mentioned, we're going to get your information, title company information. From there, we'll prepare the exchange agreement. You can either make arrangements with the title company or closing attorney to sign them in person. A lot of times they have a notary coming to you to sign the documents. We can send them to you and have you sign a DocuSign. There's going to be an assignment of the contract. What happens technically is that the assignment basically tells the closing entity not to put the funds in the name of the seller, but to wire those funds to the qualified intermediary to be held. There's also a notice to the buyer that this assignment is happening. That it doesn't really act as any kind of deal point to the transaction. It's more of a disclosure. And there are the account forms. So we're going to prepare the exchange account forms so those funds get wired to the proper institution that's handling the sale. So that's it for me. I know you had some more questions. I'm putting my contact information up here on the screen for anybody that wants to reach out to me. We have a fantastic website. We've got over 200 different topics. If people want to calculate their capital gain, they want to calculate their 4,500 days, or just look into 1031 and more in general, we have a great website for that. We're also on the social media too.
Well, yeah, thank you so much. This was great information. And I do have a few more questions for you. On that slide with selling one deal and buying three, what if you purchase two within that 180-day period, but the third is outside that period? What happens?
Your exchange is over at the end of the 180 days. So you cannot use the 1031 money towards that third purchase.
And does that mean that you pay taxes on only that portion of the 1031 money?
That's correct. So let's say you used 800,000 of the million, there's 200,000 left over. You're just going to pay taxes on that $200,000 difference. Yeah.
Okay. Got it. Also, I've heard of a transaction called a reverse 1031. Can you explain what that is?
Sure. And it's a great tool for people that have the ability to want or need to buy the replacement property first. First things first, you cannot exchange into a property you already own. So if you go out and buy a property, you cannot later sell that property and exchange into a property you already own. So what happens is the IRS issued a revenue procedure back in the year 2000. It's called 2000-37, allowing the qualified intermediary with funds from the exchanger to buy and start title of the new property. So kind of the standard practice is you go out, find the property, write an offer on it. It's a great deal. Maybe it's an REO. You got to close it within 14 days or 30 days, but you still have to get your tenants out of your old property. So that contract with that replacement property gets assigned to an LLC that we create. That LLC with the taxpayer, from funds from the taxpayer, closes on the replacement property. So you have to either have cash or a lender that's going to understand that our LLC will be the buyer borrower initially in the transaction. That's where you have to talk to your lender about, and their underwriting people, make sure they understand that we're not going to be guaranteeing their loan with that LLC. From the time that we take title of that property, you have 180 days to close your old property and exchange into the new property that we're holding for you. So it's a great tool, more expensive. We charge anywhere from between $9,500 to $10,000 for that structure. So it's got a pencil for you.
I see. So basically that would work if you're in the process of buying and selling at the same time, and the property that you are buying would close before the one you're selling.
That's correct. Mm-hmm.
Got it. Okay. And as you mentioned, it can't be a property that you've already purchased, you already have under, or you've already purchased, you closed on. You can't put money back into that one.
Correct.
Okay. Got it.
Great.
And then moving on to syndications, I just want to clarify this because I've been involved in a deal as an LP investor where the syndicator said that they were selling. And they said, if you're interested in 1031 with us, you have to fill out a form. And if you fill the form, you will be part of this 1031 exchange. If you do not, you will get your proceeds back. And all the people interested as LP investors into that 1031 will, they identify property and they go through that whole 1031 process. But it's only for the GP and a few of the select LP investors who decided to opt in. The ones that decided to opt out got their money back. So how does that structure work? Can you explain how that works? Because the way you described before, I felt like maybe that couldn't happen.
Well, if you're a separate LP investor and you're an owner of the property, right, as an
Yeah,
LP investor, that does work.
it
But if
does
you
work.
had just one general partnership, right, that owns the property, the individual investors in that general partnership cannot do an exchange per the beginning of my presentation. This is very much like the Delaware statutory trust structure is you've got the inland owns this building along with all these co-owners, 0.044% owners. And they say, it's time to sell the building. What do you want to do? You want to sell it and do an exchange or do you want to cash out? I'm working on two right now. There are apartment buildings in Georgia where the DST Cup sponsor and says it's time to sell. What do you want to do? So yeah, it's
Okay,
just like the Delaware statutory trust structure.
got it. Okay, so what you're saying is it can happen. It's structured like the DST, and that's how you make it work tax wise.
Correct. Mhm.
Got it. Okay. Let me ask you this question. What is one piece of advice that you would give anyone who's considering a 1031? Maybe the 1, 2, or 3 most important things to think about.
Talk to their tax person first. And if they use TurboTax, it's time to find a CPA. Run your numbers with your tax person first to see if it pencils.
Yeah, because many people are focused on the tax savings, but they don't realize that, hey, it's not just the tax savings. If you could take your money out and pay taxes on it and potentially do something better with that than saving taxes and invest something you don't necessarily want to purchase, then do that. It's 1031 is a great option, but it's not the end all option.
Yep, you're absolutely right.
Okay. And if someone is considering doing a 1031 exchange, how far in advance should they contact you or another
Well, if
provider?
they're just thinking about it, they can contact us anytime.
Okay.
You have my numbers there. We have the 800 number. They just want to explore the process, the timeline, the identification rules. They call us. They can go to our website. Like I said, if they want to set up an exchange with us, then a week to 2 weeks before the closing is ideal for us. Last minute exchanges are possible. The day before closing is possible, but it does kind of create some stress on all parties involved.
Yeah. Okay. So if they're delaying this, they can contact you as close as like a week out of closing to potentially set this up. But it's obviously going to be tough, but it can be done.
Yes, sir.
If someone is a sponsor, so I guess along the same lines as the question I asked before, their sponsor, they have GP share, they have a bunch of LP partners. How long before they consider selling should they contact you?
Same
Got
timeline.
it. Same timeline. Okay.
Mhm.
That doesn't change anything. That's really it on my end. Any parting words, Bill?
No, I think we've pretty much covered it. And again, people can reach out to me or the company here to get more information.
Excellent. Well, thank you so much, Bill. This was great having you. You gave a lot of useful information to our listeners. If you have any questions, you've got Bill's contact info. You can always reach out to us at Viking Capital. We're happy to help you in any way. Thanks again, Bill.
Thank you.